been a crazy month and a very crazy week for interest rates. Let's get into it. Today is the 28th of September, Thursday. Hope everyone's doing well. Well, we are seeing interest rates a little bit better today than they were yesterday, but yesterday they were sitting at 23-year highs, y'all. You have to go back to November of 2000 to find interest rates as high as they were yesterday. The Mortgage News Daily Survey had a 30-year fixed rate loan at 7.65% yesterday. Today we are sitting at 7.60, so a little bit improved, but not much. If you go back 30 days, we were sitting at 7.29% in that same 30-year fixed conventional survey through Mortgage News Daily. We were at 7.47 7 days ago, so we're up an eighth over the last week. We're up over almost a third of a point in the last 30 days. This is all owing to what we were discussing in our call last week. The Fed is communicating that they want to see a higher target for the federal funds rate at one of the next two meetings. They communicated that in the minutes that they released that show rate predictions for the remainder of the year. The next Fed meeting is on November 1st. I'll just get right to the chase. I expect the Fed is going to go ahead and tighten at that next meeting. A lot of folks are saying that the Fed is not going to move and that they may not move the rest of the year because the bond yields are currently doing the Fed's work. And you see that reflected in current pricing. Well, keep in mind why that is. The reason for the bond market reacting as it has since the Fed minutes were released is because of the expectation that the Fed is going to move. This Fed in particular under Jerome Powell has been very, very cautious to maintain their ability to communicate and to manipulate the markets with their minutes. Right? This Fed has been very clear that when they communicate something, they generally follow through on what they have communicated. They communicated that we're going to see a likely hike by the end of this year at one of the two remaining meetings. So I fully expect the Fed to do that. I think that they will want to do that before they have a chance to see some CPI numbers that may dissuade them from doing it at one of those two. So let's play out a scenario here. If the Fed doesn't move at the November 1 meeting, which I'm suspecting that they will, and if they delay until the December 13 meeting to make this promise good, or this communication that they've released into the marketplace with their last minutes from last week, then that does cause them to wear a little bit of egg on their face with regard to where they communicated to the markets the federal funds rate would be. I don't think the Fed's going to open themselves up to that risk. I think that's why they won't wait until December to do this hike. I think they'll do it in November. And then I think we may well see a significant pause from the Fed. I think that we will start seeing the shelter component that is already trending significantly lower on a year-over-year basis. This is the portion of the consumer price index that weighs most heavily on inflation. This is primarily rents, y'all. And as we see those 12-month rents that were signed at the height of inflation being renewed, they're being renewed in the 3% range increase year over year instead of the 18 or 19% increase that we saw back in 2020, 2021. As that becomes a more firm reality within the CPI, that CPI is going to come down. We're going to see that core number dramatically better. So I think the Fed is going to fulfill the expectation that they set. I think that they will do it at their next meeting. So I hate to give prognostications because folks can put a check mark next to whether I was correct or not, but that's kind of what I'm seeing in the tea leaves, y'all. We'll see if that proves to be correct. In any event, we're in for a rocky ride no matter where we go from here. Ultimately, y'all, as inflation goes away and as Fed policy returns back to some degree of normalcy, whether that's a year, year and a half, 2 years, 3 years, the bottom line is we know interest rates at some point are going to come back down. And folks that are diving into the market today may well be ahead of the curve, even though they're going to pay higher rates in the interim. They may well be able to get the property that they want without the tremendous competition that we're going to see when rates do improve, at a time when they might be able to get sufficient seller concessions to buy some discount to get that rate into something that's palatable for them. And then 2.5 years down the road, 2 years, a year and a half, a year, whenever it happens to be that we see significant improvement, they just refinance that mortgage into something more attractive and all the while enjoy the new house that they've always wanted. In any event, that's the advice that I am giving to folks. I'm going to continue to beat that drum aggressively as we go forward. Stay blessed, stay safe. Always honored to have your referrals. All my numbers are on the screen. We will talk to you next week.